You are welcome, and you are watching now Financial Round. Oil markets on edge. Could geopolitical tensions push crude to $150? Global oil prices have surged as escalating conflict in the Middle East threatens critical energy infrastructure, sparking deep-seated supply anxieties. Brent crude jumped past $110 per barrel, briefly touching $112 in early Asian trading, following reports of an airstrike on Iran's South Pars field, the world's largest natural gas reserve. While initial reports suggest fires were contained without casualties, the threat of further retaliation and regional instability has kept markets on high alert. The global energy landscape is currently navigating a period of profound uncertainty, as geopolitical friction points multiply across key oil-producing regions. The question of whether crude oil could breach the psychological and economic barrier of $150 per barrel has shifted from a fringe theory to a serious boardroom discussion. While market fundamentals, supply and demand, usually dictate price action, the geopolitical risk premium is currently the most volatile variable in the equation. The fragility of global supply chains. The primary catalyst for a surge toward $150 lies in the potential for a perfect storm of supply disruptions. Historically, oil prices spike when conflict threatens the world's most critical maritime choke points. The Strait of Hormuz, often described as the world's most important oil artery, roughly 1/5 of the world's liquid petroleum consumption passes through this narrow waterway. Any significant military escalation in this region could instantly remove millions of barrels from the daily supply, creating a deficit that even the most robust strategic reserves could not plug. The Red Sea and Suez Canal. Recent tensions have already forced tankers to take longer, more expensive routes around the Cape of Good Hope. While this primarily impacts transit times and insurance costs, a total prolonged closure adds a layer of structural inflation to energy prices that compounds existing market tightness. The role of spare capacity and OPEC+. A move to $150 would also imply that the world's safety net has failed. Usually, OPEC+ maintains spare production capacity to offset sudden outages. However, years of underinvestment in traditional fossil fuel infrastructure, partly due to the global shift toward green energy, have left many producers struggling to meet their own quotas. If a major geopolitical event occurs at a time when global inventories are already low, the market loses its buffer. In such a scenario, price is the only mechanism to balance the market through demand destruction, essentially making oil so expensive that consumption is forced to drop. Economic consequences, the $150 fallout. If crude oil were to hit $150, the ripple effects would be felt far beyond the gas station. Inflationary pressure. Energy is a primary input for almost every good and service. High oil prices increase the cost of manufacturing, shipping, and agriculture via fertilizer costs. This would likely lead to a second wave of global inflation, forcing central banks to keep interest rates higher for longer. Transportation and logistics. The aviation and shipping industries, which are heavily reliant on liquid fuels, would face existential margin pressure. This cost would inevitably be passed down to consumers in the form of higher ticket prices and freight surcharges. The emerging market crisis. While wealthy nations might weather the storm with subsidies, emerging economies, often reliant on imported fuel, could face severe currency devaluations and debt crises as their energy import bills skyrocket. The counter-argument, why $150 might not last. Despite the fear, several factors act as a ceiling on oil prices. High prices are often their own cure. At $150, the transition to electric vehicles and renewable energy sources would accelerate at an unprecedented pace as consumers seek alternatives to fossil fuels. Furthermore, high prices incentivize non-OPEC producers, such as those in the United States, Brazil, and Guyana, to ramp up production, eventually bringing more supply to the market. Whether oil hits $150 is no longer just a question of geology or economics. It is a question of international relations. The energy market is currently a tinderbox where a single significant geopolitical misstep could ignite a price rally not seen in decades. While the global economy has shown resilience in the past, a sustained period of triple-digit oil prices would test the limits of that durability, potentially reshaping global trade and accelerating the transition away from oil dependency out of sheer necessity. Infrastructure under fire. The recent price rally is fueled by damage to high-stakes energy hubs, Iran and Qatar, strikes hitting the South Pars gas field and Qatar's Ras Laffan industrial site have rattled the liquefied natural gas market. Retaliation risks. Iran's military has warned of decisive action, signaling potential counterstrikes against regional energy assets. Tightening supply. With Qatar having previously paused some production during the conflict, the market was already sensitive to supply shocks before this latest escalation. Technical analysis. Breaking barriers. From a technical standpoint, oil's price action is decidedly bullish following US and Israeli strikes on Iranian targets. Key breakouts. Brent crude successfully cleared its descending trend line at $72 and bypassed the 200-week simple moving average at $80. Support and resistance. After a brief correction to the $80 level, prices rebounded sharply and have now closed above $100 on a weekly basis. This makes $100 the new psychological floor. Price targets. The immediate technical target for Brent crude sits between $125 and $135. If WTI crude breaks its own resistance at the $125 mark, a move toward $150 becomes highly probable. The Strait of Hormuz factor. Analysts warn that if the Strait of Hormuz is closed, the resulting supply vacuum could accelerate prices toward the $200 mark. Despite relative strength indicators showing overbought conditions, the momentum remains skewed to the upside. The market's trajectory is currently tethered to the severity of the conflict. As long as energy infrastructure remains a target, a risk premium will stay baked into the price. If disruptions persist and the $135 resistance level is shattered, the road to $150 and beyond remains wide open. Thanks for watching Financial